we'll make a few logistics arrangements to get ready for the panel, which is a half an hour discussion. We'll continue the same theme, talk about funding trends, talk about the other options, just finally narrow it down for you guys so that you have key takeaways as you walk out of the conference today. So I'll just introduce the panel. So the moderator for the panel is Sunny Singh. He's the VP of Sales and Biz Dev at Jumio. And the distinguished speakers are Jay Das, who is the co-founder and MD of SAP Ventures. We have Alberto Yepes, who is the managing director at Trident Capital. And then we have Venu, who is the investment director at Intel Capital. Welcome, everyone. Please give the speakers a big round of applause.
Hey, how you guys doing here? My name is Sunny Singh. Happy to be on this esteemed panel. I think it's a very eclectic group of venture capitalists, and with my background, it should definitely make for a very interesting panel. A little quick background on myself. My company, Jumio, we've raised about $45 million from a traditional venture capitalist firm, Andreessen Horowitz. But then we've also raised from Citibank Ventures, which is a strategic venture capitalist, as well as a well-known angel investor, Eduardo Saverin, who's one of the co-founders of Facebook. So I myself have also done a lot of angel investing, so I can kind of look at it for this panel from 2 points of view, from both an entrepreneur side as well as an investing side. To my left, do you guys want to introduce yourselves?
Yeah, my name is Alberto Yepes. I'm a managing partner at Trident Capital. I'm relatively new to venture capital. I spent 10 years at Apple, and like you, I was in the audience trying to figure out how to build my first company. I built 3 different companies, exited them, sold them. I became part of Oracle as the last sell of the last company I was with for 2.5 years. I worked with private equity firms as enterprise, as an entrepreneur in residence and venture partner, and as of 2010, I became a partner at Trident Capital. Trident Capital is a venture capital firm that's been around for 20 years, $20 billion under management, really invest in enterprise, anything that monetizes the internet, anything that makes business more efficient, infrastructure, mobility, cloud, SaaS, as well as healthcare, IT. And one of the very few venture capitalists that invest in business services, which is what built Cognizant, would build a lot of companies that provide services that eventually you provide technology-enabled services to create value for customers.
Jay?
Yeah, hi there. I'm Jay Das. I'm one of the MDs at SAP Ventures, and we are a financially oriented fund with SAP as our sole limited partner, and we manage about $500 million or so across 3 different funds. And our core focus is investing in mid to late stage companies across the globe, and some of the companies in our portfolio include LinkedIn and Box and ExactTarget and Just Dial out in India. And my background, I started out as a developer programmer at Oracle, spent some time there, worked at product management, and then kind of after business school, started investing first at Intel Capital, and then at DFJ, and then have been at SAP Ventures for about 8 years now.
Hi, Venu Pemaraju, investment director at Intel Capital. I've been there for 13 years, and I focus on mobile investments and enterprise software.
Great. We just heard a couple of different panel people speaking before about incubators, and Silicon Valley Bank was talking before that. The market's very crowded now. There's a lot of different venture capital firms out there. There's a lot of incubators. There's a lot of angels. It seems like there's a lot more competition chasing for deals. Alberto, how do you go about finding these type of deals now and competing against all these other firms out there? If I'm an entrepreneur, I can go with so many different choices, so to speak.
I think it's a network effect. Entrepreneurs talk to entrepreneurs. You sit on multiple boards. I sit in about 8 different boards, and the best leads that I get is my existing entrepreneurs tell me, look, I know a friend of mine started a really hot company, you should meet with them. Or we also get sources from our ecosystem. A lot of the corporate attorneys, Silicon Valley Bank, believe it or not, there's actually a system that works with it, and people self-select. People, as much as you're trying to go after a name brand VC, what is very important is you work with the individual that's going to help you build your business.
Right.
And even sometimes even your customers actually bring you deals. In the case of, we work very closely with Incutel, we work really closely with the defense and intelligence community, and oftentimes they find really golden nuggets, but they want to introduce into people that help build global companies, and that's the deal source that we get.
Do you prefer if the entrepreneur you're talking with has already gone through an incubator or has raised angel money, or does that not make a difference?
No, it doesn't really make a difference. No, I've been an entrepreneur. I've been on the other side. The best capital you need to raise is a customer purchase order, okay? That doesn't take any dilution. It doesn't get anything, and also gets the angels, the VCs, everybody to get excited about your company because you just validated your idea. So don't be confused. We create businesses because there's customers that are going to give you money for what you do. So the best source of funding, let me just repeat, if there's one takeaway from this session is a customer purchase order. The second thing you need to figure out is the alignment of who's actually going to be investing. If you get an angel or a VC, what is the mindset of the VC is we invest with liquidity in mind. We don't invest just for the sake of investing. We get measured. We have limited partners. And to my left, we have a couple of corporate investors that do have a one LP. In our case, we have maybe 20 LPs. And guess what? They measure us in how often and how quickly we return money. The venture industry is going through a crisis, even though there's a lot of money, there's fewer VCs, because what the LPs want is people constantly returning money. Therefore, again, long answer to your question, we don't necessarily care. What we're looking for is more ideas, teams that have validated offerings by customers, whether they've been either taking the time to vet the solution or, more importantly, they have paid money for people to do that.
Now, Jay, Vimu, you guys are a little different since you're more strategic venture capital. Does being with Intel or SAP help you find deals, or maybe actually hurt you find deals?
So we look at deals and we look at investment opportunities, irrespective of what SAP is doing, right? We are independent of SAP, they're just an LP. So in some sense, it's like a double-edged sword, because at some point it does help us when we are actually talking to entrepreneurs. We can leverage the whole SAP ecosystem for them, so it's definitely helps us in that respect. But there's always also the other thing that people, then you have to convince them that, look, you're truly independent, versus that that you're not going to do things and share all their confidential information with your LP, right? So we have a challenge there. But overall, I would say it is I think personally, like if I went out and said, hey, this is Jay's VC company, it would be much harder to invest in a company or with an entrepreneur rather than saying it's from SAP Ventures.
Are you able to move just as fast in investment as a traditional VC?
Yeah, we don't have, our investment committee is just like in any other VC. We have 7 MDs, and we have an investment committee, and we decide and we go, right? So that's it.
And Vimu, in your case?
No, I don't think it hurts. I mean, there are situations where, the entrepreneur may feel that, that maybe Intel is probably not the appropriate investor, but those occasions are very rare. I think at the end of the day, investors entrepreneurs are looking for who's going to add the most value to us. And I think, do these people have the credibility and the reach to help me get to that next stage? So I think it's less of a question of, is it a hindrance or not? I think it's always a question of, do these people add the value that I need to get to the next level?
And that actually is a great segue. It's almost like if we planned that. Adding value. So when we just did our last round at Jumio, we picked up Andreessen Horowitz, and they've just been a great firm to work with because they add so much value. They're constantly doing enterprise introductions for us, introducing the key people, helping us recruiting, find talent, and do some marketing, and they've really been a great benefit, actually. I would assume, and again, with Intel or SAP, it's that I want to go, if I'm an entrepreneur doing enterprise software, something like that, to you guys, because you can help me do intros and add that type of value. Is that the case?
It's interesting, the value, we use one word for it, but, in terms of what value is, there could be 20 different vectors on which you can add value. So it, again, depends upon what kind of value you're seeking. Are you seeking value in terms of expanding to international markets? Are you seeking value in adding to your headcount? Are you seeking, technical help in evaluating whether your product is good product or not? Are you having manufacturing difficulties? So I think, again, depending upon the type of products you're developing, the stage at which you are, I think the value add is quite different. So if it's a semiconductor company, we add a different kind of value. If it's an enterprise software company, it's a different kind of a value. But suffice to say, the reach that we have in terms of the global presence, the global footprint, the people that we have internally in terms of, their experience in helping the companies. So it's a combination of all those things that I call value. And again, it depends upon the stages of the company and what the company is doing.
Right. Now, Jay, actually with SAP, I was just at your booth looking around, and I was wondering with the HANA project and all that, and how you actually have kind of a database for startups.
That's right.
Because no one would consider SAP is not only not known for working with startup type companies.
That's
actually.
right.
Do you want to talk about that and how that would work?
Sure. So, we actually announced an additional, actually we have one fund that is targeted towards real-time enterprises, right? It's called Real-Time HANA Fund. And one of the things we have decided to do is that, create an ecosystem around HANA. And what we realize is that, you can't invest in a company and expect them to use HANA, right? The companies are going to decide on the stack that they want to go after and they want to use, depending on how good that stack is. So what we have done is chosen to do is actually go and invest in other early stage VCs, seed investors, who act as our proxy and who actually are knowledgeable about the HANA ecosystem and the HANA platform, and actually go and ask their portfolio companies to at least take a look at the platform. And then, if it makes sense, they build up their application or their, whatever their product on the HANA platform if HANA wins based on, competitive kind of analysis with other competing products. And, the way we do this is instead of using dollars to actually force people to do it, we kind of just want to create an ecosystem and market the platform, and then people will choose it on its own merits. Right.
Yeah, it's interesting stuff. I was just learning more about it because, again, I would never have thought SAP for that kind of stuff. So one question actually I have, it seems like the tech community is becoming divided, where there's the enterprise, infrastructure software play out here, and it seems to be most of the people here, and then there's kind of the whole tech crunch community, where all the new apps, the younger kids that are making these Facebook, social media type things and all that, and you guys, your firm's more of an enterprise background. How do you get involved with those type of deals, or do you just not get involved with them at all?
We recognize that, and I think that's the reason why we have different groups within Intel Capital. So there are groups that are focusing on the consumer side of the software business, whose focus is exactly what you described, consumer applications, whether it is mobile, whether it is second screen, whether it is, connected home or whatever. So there are groups, consumer internet group, the connected home group, that are focusing on those aspects. And then there are groups that are focusing on the enterprise side as well. So given that we've been around for probably 20 plus years or so, there are different groups, focusing on all of those aspects. Now the question is, do you invest the same amount in all of those segments or not? And that is probably a function of, what the needs are and how that year looks like. So, but suffice to say, there is investment going on across all of those segments that you just described.
So for us, actually, we don't, we look at consumer apps, we look at all of those, e-commerce deals. The challenge has been the valuations of these things has been extremely, extremely high the last 2 to 3 years. We probably have looked at every e-commerce deal that's been out there, kind of raising money, and we have passed on them. But we have investment in LinkedIn, and then we have an investment in India. So what we have decided, in the US, because we have limited bandwidth and also limited dollars in terms of investment. So in the US, we typically focus more on enterprise-oriented, or kind of the crux of enterprise and consumers like LinkedIn or Box. And then in across the world globally, we are investing a lot more on the e-commerce and consumer-oriented companies. So we are investing in a company called Just Dial that is just filed for its IPO in India, and and it's basically a consumer-facing hyper-local search company.
Yeah, in our case, LinkedIn, well, as much as you think it's a consumer company, a lot of where the money is coming from is from enterprises. Yeah. Facebook, Google. So I think there's a little bit of a fallacy going on. I know that there's these initial expectations you're going to create crowds and groups using your stuff for free, but eventually the people that bring the money is the enterprise that has to deal with it. So we do invest in, we were investors in HomeAway. Is it a consumer company? Is it an enterprise company? We've done really well. It's multiple billion-dollar market cap. But again, it's aimed at the consumer. We provide a set of services that sometimes consumers, but also enterprises, because of advertising, deal with it. So again, there's dynamics on valuations and everything else, but at the end of the day is what value do you deliver to consumer and how you're going to charge for it.
Right. And Jay, you had mentioned that valuations you thought were getting a little high in the e-commerce side. Do you feel there's a little bit of discrepancy before e-commerce valuations versus enterprise valuations?
Yeah, so like last year, like the enterprise valuations all have gone out of hand, right? And I think it had started to come down, but now everybody's going to, every deck we're going to see will have Tableau and Marketo up there as their comps, right? They used to have Splunk and there was another ServiceNow as a comp. So now you have like 4 companies trading at these outrageous multiples. So it's going to be interesting to see whether enterprise values really come down. And we also typically play in the mid to late stage. So this is like Series C or D, where companies have revenues, companies are growing, and entrepreneurs all expect the same kind of 20 times multiple that the public markets are paying for 4 companies.
Right.
I think sitting on the investor side, valuations are always high. When you sit on the entrepreneur side, valuations are always low. So that balance keeps going on and on.
That's true.
Do you find a lot of people now are selling, the entrepreneurs are selling shares in the second markets and the private exchange and all that, or companies are doing buybacks the way Twitter did? Are you guys in favor of that? Do you like that kind of stuff for entrepreneurs, for the way to liquidate?
The whole reason that's happening is it's taking longer to get a company to liquidity. So that's the bottom line. So you have people that have been in a company for 6, 8, 10 years, 12 years. They need to have some sort of liquidity, and that's why the secondary market is started. And the other thing that really started the secondary market is there were a lot of these money that was deployed, in the mid-2000s, 2008 crash. A bunch of VCs couldn't sustain those companies, and therefore the secondary market, they went in and says, I'm going to buy your portfolio as a secondary to be able to do that. So you need to figure out the reasons. We're very supportive to give partial liquidity, but somebody said in the prior discussions is everybody has to be aligned in terms of what the ultimate outcome is. So having entrepreneurs with a stake in the company that motivates them to make them more valuable day in and day out is important, and giving them the ability to do partial liquidity is important as well.
Right.
It also is the function of certain late stage VCs coming in and they want to deploy a large amount of capital, and there is no way the company needs that level of capital.
Right.
So you have no choice but to if you want that investor in place, you are going to do some secondary purchases as opposed to just going all of it on the balance sheet.
Right.
Yeah, and I think the last, I would say, 10 deals we have done have all secondary components. And what we look really carefully is that how is that secondary component being shared, right? If all of it goes to 1 or 2 individuals and it's a big chunk of money, it hasn't happened to our portfolio company, but we have heard that sometimes, the individuals who do get that kind of windfall basically check out, right? So there is a fine balance between how much, if it's a VC kind of taking out, that's fine, because an investor, they have to return to the LP. It doesn't matter as much as to an individual. So we are very cognizant of how much capital is being taken out by whom.
Now, the great thing about you guys is, you've been around since '99 for the earlier days and seen a lot of ups and downs, actually, and a lot of different deal flow and all that. Do you think the quality of the startups right now are better than what you were seeing back in those days?
I don't know, my memory is short, so I don't know. But, the quality aspect is always there on the good companies. I think what you're seeing is too many companies sometimes in a similar space. And so it becomes a little bit harder to determine, who's going to succeed at the earlier stage. So the propensity is, to wait a little bit more so that, the weaker ones die, and then you wait for the ones that survive and see whether those have the quality that passes muster or whatever. So, it's a good question, but I don't know how to compare it to 2000.
Sure.
It's just that the number of companies out there is just way too many, and separating the good from the bad is a little bit challenging.
No, I think that definitely the technology hasn't, I don't think from a technology point of view, hasn't changed that dramatically. It's definitely far cheaper. Ravi was saying before the panel here that it's $50,000 is worth about $5 million in 1999, and I kind of agree with that. But I think one of the things that has happened is on the sales and marketing side. I think people have figured out, including investors, what are the models of sales and marketing work, right? And they have figured out, people have done that before, and they know how to tweak the models. So it's a lot easier for companies, if they get one or two customers, to figure out, okay, what is the right sales and marketing, and then just ramp the sales and marketing with bringing in people from the appropriate companies.
Yeah, and that goes back to Alberto's point. For a lot of people, the enterprise, startups out here, the most important thing is getting customers, new customers, to show the traction you're having. If you get all that, the VCs, the investment will all follow later on, actually.
Because once you have 2 or 3 customers, you know what the sales model is it a $100K ESP, it's $1 million ESP, is it a $25 ESP, right? And based on that, there are all these different models out there where you can recruit people who can go and drive sales really quickly.
Yeah, and unfortunately, though, getting enterprise customers is very hard, though, as a startup company. That's where...
So one thing that I always hear in these forums is always much cheaper to start a company. I think that's true. But still, when you look at and point at the companies that are being successful, it's not. No. It's more expensive to do sales or marketing than creating the product and developing the product. So in a logical enterprise company, you'll probably deploy anywhere between 40 to 70 million investment to actually make it successful. I'm just trying to make the extreme, but it's all about the efficient sales model. And yeah, it may take you $5 million to get your initial product, but the reality is, because of the cloud, because of all this open source stuff, yes, but don't get confused. It's a long ride, and at the same time, what is becoming more and more expensive is sales and marketing, creating that ecosystem so that you can get the customers to get the global scale. That's expensive. Look at your current salaries, multiply that 10 times, 20 times, depending on the people you want to have in sales. So it's engineering in sales and marketing is probably more expensive now than it used to be in the past.
But I was
just going to say, I think the CapEx portion of starting a company has come down. The OpEx portion is still the same as what it was before. It's probably higher today. So that's the way I would put it. So that's why the starting cost is lower, but the sustaining cost is still the same as what it was, or if not more expensive today.
Although I will argue that the VCs don't invest in companies where the CapEx costs are really high. So, semiconductor company will highly unlikely that it gets...
That's not what I meant. What I meant was, in general, you don't have to buy servers, you don't have to get the big licenses and things like that. That's
absolutely. But I also think that VCs are scared of investing in companies that will take a lot of CapEx to go and build a company, right? Because, with OpEx kind of risk, it's variable, right? If it scales, you can put more money in, but an CapEx risk is basically you're putting in $30 million to build a chip or something else, and then see if you can get the customers. So I think there's also been a shift in the way VCs look at investments, right? That people, some investors still will make these big bets and put in 30, 40 million before getting any revenues, but you don't see that happening as much as it used to be like 10 years ago.
Right. So next question, I guess, is more for Alberto and Vimu, because we were on white stage, Jay, is when you're investing, is it more important? Is product more important or team more important? That's kind of the oldest question in the book, but I want to hear your opinion on that.
I would say team, but it's not just product or team. It's that, we have a criteria of about 5 different things. So allow me for a moment. It has to be a large market opportunity. So the opportunity has to be global. Number two, the IP, the technology, not necessarily the product, because the instantiation of that could be multiple products, and the multiple product lines has to have a high bar and has to be defensible. That's why IP is becoming more and more important, especially now with first to file versus first to invent. So that's a big issue that we have now in the Valley. Number three is that ecosystem of partners to help you to take you to market. Number four is the team, and number five will be the investors that are next to the company. You align all those five, you have a successful company.
Sure.
The answer is yes to what you asked. And again, I don't have anything more to add to what Alberto said, but I think there is something to be said about, when people say team, what does that mean? Is it, their educational background? Is it the companies where they have worked? But there is a desire to invest in people who have shown a track record of success. And then there is something called chemistry, and I don't know how to describe it, but there has to be chemistry in the team, and you have to connect with the team that you're investing in. Just because it's a great team doesn't mean that you may have a good connection with them or not. So I think there are lots of intangibles besides things like the market. Is a product good, or are these guys great credentials, or whatever? And sometimes it's difficult to kind of articulate those intangibles that go into your decision making, other than just the fact that it is, the things that you describe. But I agree with Alberto. I mean, those are all the reasons that you have to think of. But in addition, you have to think about the intangibles as well.
So everyone always talks about their great hits and home runs they've had as a VC and an investor, and they've also talked about the failures they've had sometimes. But what about the ones you've missed, actually, and just passed on? So me, myself, I've passed on the seed round of investing in Buddy Media, which just sold to, say, Facebook or Salesforce for about $900 million last year. I also passed on LifeLock, which just IPO'd. So I've got my two that I hold my hand high about and all that. But what about you guys? Have you passed on any that just you didn't think were good?
We passed on Fortinet, and we passed on Palo Alto Networks. Billion-dollar business as well.
We passed on Marketo.
Yep. Very time appropriate too.
That's right. There's a bunch of, I have to go back and remember, but nothing else comes to mind. But
I'm like a baseball player. I have short memory. I don't fret about what I missed. I worry about what I have and how do I grow them.
Very good. So we only have about 3 minutes left, actually. For this next part, though, it's more for the attention deficit disorder people like myself. That just one-word answers. I'm asking you yes/no type questions. Actually, we're still kind of rapid fire. Do you think valuations are frothy right now?
Yes.
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 Do you think this conference will ever take place in San Francisco?
No.
Why not?
2 years from now, and this, by the way, all these questions are general topics, actually, outside of their sweet spots and comfort zones. 2 years from now, will BlackBerry be a standalone company?
No.
No comment.
You sell chips.
Do you have a Facebook account, and if so, how many friends do you have?
500.
2.
No, I do. I don't know how many I have. Could be 500, could be 200, but I don't know if they are friends or just, connections.
There. Do you check your Facebook account every day?
Every other day.
No.
No.
About 5 years from now, do you think Google will be as strong as it is today?
Yep.
Yes.
No comment, but yes.
3 years from now, will you be carrying around a personal computer as much as you would be now? Or will most people be using personal computers anymore?
Nope.
No.
Yes. Why is that funny? Isn't this a personal computer as well?
I should have specified more, yeah.
I'll have a computer. It'll be personal. I mean, what form factor it'll be, I don't know. But yeah, I will carry one.
3 years from now, will there be more or less IPOs in tech?
More. What were the questions?
More or less IPOs 3 years from now?
Hopefully more. Can't predict the market.
Yeah, that's a hard one. I hope, hopefully more. But there's all kind of headwinds in the economy that people don't talk about. But yeah.
I really don't know, and the reason I say that is because there is a lot of cash sitting on the balance sheets of large companies. So there are certain hurdles and requirements that go around with an IPO. So my guess is that with companies sitting on so much cash, it may be equivalent of an IPO when somebody acquires it for a couple of $1 billion or whatever. So I think is an M&A of $2 billion same as an IPO? I don't know, but it's quite possible that we may see less, but that doesn't mean that the markets are bad.
Or an investment or a private investment of 200 million. Is that an IPO?
For 3 years from now or a couple years, is angel investing still as popular, or is there an angel bubble crash that's happened in the next couple years?
Bubble crash.
Yes, bubble crash.
Wow.
Bubble crash, but as long as people have money, they have confidence that they can pick the winners. So I think it'll still be there.
And then 3 years from now, are there more or less incubators?
About the same.
I would say less.
I don't know.
They may be around the world about the same. I'm not saying that it's going to stay the same here in the U.S.
I think you may see more incubators in the emerging geographies, so-called emerging geographies, because there are wealthy individuals who've been successful entrepreneurs, and I think they will replicate the model that you see in the Valley here in other countries. And that's not very surprising, because if you look at the successful companies, especially on the consumer side in the US, you see similar companies in the other geographies as well.
Right.
So I wouldn't be surprised if you see a large increase in the number of incubators outside the US. And so in total you'll have more, but maybe less in the US.
I'll be contrarian on that. I think the reason I say that, it's not because people don't want to fund incubators and things like that, but just from a regulatory perspective, because we invest in Europe, we invest in India, we don't invest in China, but we know a little bit about it just from a regulatory perspective and tax perspective and all kinds of issues, it's just hard to for a wealthy individual to go and invest in an incubator.
Where there is a will, there is a way.
And then last question, are you more bullish on tech investing in Silicon Valley or India? And it might not be applicable to some of you, but...
Silicon Valley.
I invest only in the US, so it's hard for me to sit here and prognosticate about what happens in India.
Yeah, Silicon Valley, because the U.S., the only competitive edge that we have right now to compete on a global basis is our innovation and technology. And if we don't do that, we're going to be in trouble.
And I guess Vimo and Alberto, do you guys prefer companies to be based in Silicon Valley versus New York or Chicago? Does that make a difference?
I don't think that's an issue for us, because we have a fairly large team in India whose charter is to invest in Indian teams. And given that I'm based here, my charter is primarily to invest in US companies. But given that our teams are based across the globe, each one is looking at investments in their space, so that's not an issue for us.
So I'll clarify the comment about Silicon Valley. So, I'm not saying that there are not entrepreneurs who can start companies across the globe, right? We have invested in companies in India, in Europe, things like that. But what we find is, if you look at all the successes, right? Companies like Zendesk, MySQL, Spotify, they all started in Europe, but they all ended up moving to the US because a big chunk of their customers, and as they scale their product marketing, as they scale their, business development, all the ecosystem is here. So, what we are seeing now increasingly, and some of the venture funds in India are doing it really well, is basically after they have the product ready, is moving the team all the way to the US, especially on the enterprise side, and then building the company sales and marketing and business development team all here. Because the ecosystem, fortunately, is still in the Valley.
Great. Well, thank you very much, guys. I think we're out of time. The red light's about beeping.